Stock market terms explained. In plain English, no jargon, no finance degree required, no confusing charts thrown at you. If you've ever heard words like PE ratio, bull market, or ETF and nodded like you understood, this video is for you. Today, we're breaking down the most important investing terms every beginner needs to know through story, real-world examples. Quick disclaimer, this is for education, not financial advice. Think of me as your translator for Wall Street language. All right, let's start at the very beginning. What is a stock? Imagine your favorite company. Maybe it's Apple, Tesla, or Coca-Cola. When you buy a stock, you're buying a tiny piece of ownership in that company. If a company were a giant pizza, one share is a slice. The bigger the company grows, the more valuable your slice becomes. There are two main types. Common stock, what most people buy. You may get voting rights and possibly dividends. Preferred stock, usually no voting rights, but more consistent dividends and priority if the company pays out profits. Most beginners start with common stock. Now here's the key. When the company grows its profits, your ownership becomes more valuable. If the company struggles, your slice shrinks. In 2023 alone, the US stock market was worth over $40 trillion. That's trillions of slices being traded every day. But where exactly are they traded? What is the stock market? The stock market is not a single building. It's a network of exchanges where buyers and sellers meet. Two of the biggest exchanges in the world, the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE is the historic trading floor you see in movies. NASDAQ is fully electronic, fast, digital, and home to many tech companies. When people say the market is up today, they usually mean major indexes are up. We'll get to those in a second. Prices move because of supply and demand. More buyers than sellers, price goes up. More sellers than buyers, price drops. But here's the twist. Markets don't just run on math, they run on emotion, fear, greed, optimism, panic. Delta once bought a stock because everyone online said it was going to the moon. It did go somewhere, just not the moon. Indexes, the market's report card. An index tracks a group of stocks to show how a portion of the market is performing. Think of it as a scoreboard. Here are three major ones beginners should know. S&P 500 tracks 500 of the largest US companies. Dow Jones Industrial Average tracks 30 major established companies. NASDAQ Composite, heavy on tech companies. If the S&P 500 rises 10% in a year and your portfolio rises 6%, you underperformed the broader market. Historically, the S&P 500 has returned about 8 to 10% annually over the long term before inflation. That's why it's often used as a benchmark. Indexes help investors measure performance and build funds that mirror the market, which brings us to the famous animals of investing, bull versus bear markets. When prices rise for a sustained period, that's a bull market. Confidence is high, headlines are optimistic, investors feel unstoppable. And when prices fall 20% or more from recent highs, that's a bear market. Fear spreads, news turns negative, people panic sell. In 2008, during the financial crisis, the S&P 500 dropped more than 50%. In 2020, during the COVID crash, markets fell about 34% in weeks, then recovered within months. Markets move in cycles, always have. The biggest mistake beginners make? Thinking downturns are permanent. They're not. They're part of the system. Public versus private companies. A public company sells shares to the general public on an exchange. Examples, Apple, Microsoft, Amazon. A private company does not offer shares to the public. Ownership stays with founders, employees, or private investors. One key metric, earnings per share, EPS. EPS, greater company profit, number of shares. If a company earns 10 million and has 1 million shares, EPS is $10. Investors compare EPS to expectations. If results beat expectations, stocks often rise. Miss expectations, stocks can drop fast. Then there are dividends. A dividend is a portion of profit paid to shareholders. Companies like Johnson & Johnson and Coca-Cola have paid dividends for decades. Dividend yield shows how much income you earn relative to the stock price. But high yield isn't always good. Sometimes it signals trouble. Always ask, is the company healthy enough to sustain those payments? Market cap. Company size matters. Market capitalization. Market cap. Targeting share price. X total shares outstanding. It tells you how big a company is. Large cap. 10 billion plus. Mid cap. $2 or $10 billion. Small cap. Under $2 billion. Large cap companies tend to be more stable. Small cap companies can grow faster, but are riskier. Think skyscraper versus startup cafe. Both can succeed. But one shakes more during storms. PE ratio. Is it expensive? The price to earnings, PE ratio, tells you how much investors are paying for $1 of earnings. Formula, stock price, EPS. If a company trades at $100 with $5 EPS, PE or 20. That means investors are paying $20 for every $1 of profit. High PE might mean high growth expectations. Low PE might mean undervalued or struggling. It's context that matters. Never judge a stock on one number alone. Volatility and the VIX. Volatility measures how much prices swing. Some stocks move 1% a day, others swing 5 to 10%. The VIX is called the fear index. When it spikes, investors are nervous. High volatility isn't bad. It's just movement. The danger isn't volatility. It's emotional decisions during volatility. Orders. How trades actually happen. When you buy or sell, you place an order. 2 main types. Market order executes immediately at current price. Limit order executes only at your chosen price. Market orders prioritize speed. Limit orders prioritize control. Stocks trade using bid and ask prices. Bid, what buyers will pay. Ask, what sellers want. The difference, the spread. In highly liquid stocks like Apple, spreads are tiny. In thinly traded stocks, spreads can be wider. Liquidity simply means how easily a stock can be bought or sold without affecting its price much. Diversification, your risk. Shield diversification means spreading investments across different companies or sectors. Why? Because no company wins forever. Instead of putting all your money into one stock, you spread it out. If one falls, another may rise. This reduces risk. It doesn't eliminate it, but it smooths the ride. ETFs and index funds. Beginner-friendly investing. Instead of picking individual stocks, many investors buy ETFs or index funds. An ETF, exchange-traded fund, tracks a group of stocks and trades like a stock. An index fund tracks an index like the S&P 500. Instead of researching 500 companies, you buy exposure to all of them in one move. Low cost, broad diversification, long-term focus. This is how many retirement accounts grow steadily over decades. Sometimes simple beats complicated. Blue chip versus penny stocks examples include Procter & Gamble, Coca-Cola, and Microsoft. They've survived recessions, wars, and crises. Penny stocks trade at very low prices, often under $5. They promise massive upside. But most are highly speculative and risky. Some succeed, many don't. Understand the risk before chasing the reward. Every investment carries risk. Higher potential return usually means higher risk. But here's the real edge most beginners overlook: time. Historically, the longer investors stay in the market, the lower their chance of losing money. Trying to time short-term moves often backfires. Time in the market beats timing the market. That's not flashy, but it's powerful. Today you learned what stocks are, how exchanges work, what indexes measure, bull versus bear markets, market cap, PE ratios, volatility, dividends, earnings, ETFs, diversification. These aren't just buzzwords. They're the foundation of investing. It becomes understandable. Predictable? No, but understandable. If this helped you, hit like, subscribe for more beginner-friendly finance breakdowns, and tell me in the comments which stock market term finally clicked for you today. Remember, stay patient, stay diversified, and never let emotions make your investment decisions. I'll see you in the next one.